Right, so today we're going to start the second part of the module one, and the title for this one is Understanding How Forex Market Actually Works, or how do you do your Forex trading. So you need to understand a few things. That's first of all, you need to know that the Forex is always traded in a pair. What does it mean? That if you want to buy US dollar, you actually give Australian dollar. If you want to buy euro, if you want to buy euro USD pair, then it means you are giving USD dollar and you are getting euro pair. So it always works in a pair. The second thing you need to understand that there is a huge leverage available in the Forex market. If you use leverage properly, then it will be it will help you to grow your portfolio. But if you don't understand the leverage and you don't use it properly, then can it actually destroy your entire portfolio and your saving as well. That's why I say that it's highly risk the trading is if you don't understand what the leverage and what the trading is. The third thing you need to understand is the impact of overnight swap or interest. So when you open a position and if you carry that position overnight to the next day, based on the which currency pair and which side of the pair, whether you actually have bought, you may pay interest or you may receive interest. So those who want to the trade interest-free or swap-free, they can actually request their broker. IC Market can allow you to do interest-free investment and interest-free trading. In this case, they won't actually charge you any swap or interest, or you don't actually pay anything for that, or you don't receive as well. Another important thing is the risk calculation. If you can't do your risk calculation properly, then it's most likely that you're going to lose that particular trade. Risk calculation as an overall of your account and risk calculation on your per trade or your per position base. These both things has to be worked out very, very well. In ICAP or KVT, K5 vertical trust, or any other investment, what we do in K5 trading, our maximum loss is locked or kept to the 5% of the total portfolio amount. And then we also further distribute that risk based on each individual asset class we actually trade on that. Stop loss, if you don't use the stop loss, do not trade at all. No trading without a stop loss. The reason why there is no trading without the stop loss is if you don't have a stop loss and market goes against you, then most likely that you will lose your entire portfolio or your entire account balance. Risk to reward ratio is also very, very important, and you need to make sure that your risk to reward ratio is at least 1-to-1 or 1-to-2. 1-to-2 is most probably you can have it, or you should have it. But if you can't, then the minimum is 1-to-1 risk to reward ratio. You must have it. How to calculate risk to reward ratio, we will cover in a few slides, or during maybe on weekend training session. The next things now we're going to cover is the trading time zones for the Forex. Forex market start around 7 a.m. Australian time and goes up to 4 p.m. Australian time. Tokyo market start 9 a.m. Australian time, and Frankfurt start 4 p.m. Australian time. London start 5 p.m. Australian time or Sydney time, and New York start 10 p.m. Sydney time. The market actually run from 7 a.m. Sydney time until 6 a.m. On the next day. So it's a 24-hour market. The different markets operates on the different time zone in the different part of the world. The most liquid and most active market is always the London market, and where actually the London and New York meet, that will be the most likely where most of the volume at that time. So sometimes it's London actually called nylon as well, NY New York and London for nylon. So that time frame you can see here, which is around 10 p.m. Australian time, right up to 12 midnight, and that's time when the London and the New York actually overlap. London market, they are preparing for the close and they are selling or closing their position. New York is opening and they are having their position open, or they are just going through their initial buying or selling, whatever. So that's part is very, very active. The Sydney market, mostly 7 to 9 o'clock, is always very quiet, low volume. And most likely, if you open any trade here, it's highly likely that it will change the trend when the Tokyo market will open. Tokyo is the cover most of the Asian market and is quite active. It's not as active as the London, but it's still very active market. It's active than Sydney. So the time when you want to trade, basically your Forex, if you are in Australia and you have a time during the day, is 9 a.m. or 10 a.m. right up to 2 or 3 p.m. That's where you have to trade. You get most of these two people's market. I mean, these two zones market. If you are trading on the evening or afternoon, then your best bet is from 6 p.m. or 5 p.m. when the London open, right up to the midnight when the London and New York actually overlap, and then after that's London close. The market only open Monday to Friday, 24 hours a day. It doesn't operate during Saturday and Sunday. So Saturday morning, 6 a.m. Australian time. After that, the Forex market close. The Forex market structure. Forex is the world's biggest and most liquid market, $5.3 trillion a day being traded in this market. Open market, there is no central exchange at all. And all the exchange, they connected to each other via router, EBS, or their liquidity provider, or they got a peer-to-peer networking somehow. So this is how it's actually the link together. So you have this two big network in between router and EBS. These are the large liquidity provider bank. Example of those bank is, let's say, the Morgan and Stanley or HSBC or some other kind of the large bank, Deutsche Bank, or what else other banks you got in America? American Express, probably not a bank, but yeah, so those big banks are here. They communicate to each other via EBS or the router. And for example, let's say a bank in America, the large bank in America, Morgan and Stanley, they want to buy 70 million British pounds. So it means they will sell 70 billion equivalent of the US dollar through this network. And they say, I want to buy a British pound against that one. Some bank within London, which is again a large bank, maybe HSBC or whatever, they can respond to them and say, yes, I can provide that one. The deal will happen between these two through this EBS and the router, and then they will money actually change hands, and the trade is completed between these two large banks. Now you need to understand that this large bank, they have many smaller bank attached to them. So those smaller bank, for example, this is Commonwealth Bank and this is National Australia Bank. And this is a smaller bank somewhere in Europe. If Commonwealth Bank want to buy about $2 million Australian dollar worth of euro, it will send its request to its liquidity provider, which is one of those large banks. The large bank then actually throw the order into the market in EBS and router network. Whoever actually put their hands up to buy those ones, and that's how then the deal will actually close through this network again via their larger liquidity provider. So the liquidity provider actually play a very, very, very big role on this one, and because their volume is quite large, so the bid and ask spread is very, very tight. Sometimes it's less than 0.0001 cent. But because of the volume, they can actually make quite good amount of the money on this one. So smaller banks, they connected to the larger bank, and they are the intermediary bank for them. And the same time, this part on your left hand side is the retail market. Retail market consists of the different broker and the trader like you and me, and some online traders. So those the broker, they are actually they got a liquidity provider or liquidity provided by those large banks. So these large banks, they are their liquidity provider. It means that any order they have for the Forex, they send it to their liquidity provider. Liquidity provider that goes again via EBS and the router, and then send the completion of the order back to the broker. Broker will send to the trader. So you can see that's the large bank or the liquidity provider or the larger bank, they play a very, very big role again. So the trader actually, when he places an order with his broker, maybe the spread between here and here is, let's say, the 2 pip or 3 pip. Then between the broker and this liquidity provider, the spread maybe from 3 pips to reduce to about maybe 1 pip or 2 pip, whatever. And then between these two large banks is further it's break up, and then this goes very, very tiny in this Biscode network. Sometimes those broker, they have a millions of customer within their own network. So if a trader put a buy order for Australian US dollar and another trader within their own network put a sell order for Australia and US dollar, then they will settle these two traders deal within their own network. And that way the broker don't have to pay any commission or any spread back to the large service provider or large liquidity provider. Broker also have a peer-to-peer connectivity between them as well, and they can actually trade within them as well, bypassing the liquidity provider altogether. And that's what's actually happened if the trader close position within its own network with another trader. That's actually he's actually taking all the commission with whatever the spread is and the commission from the both parties. So he is making money on this one. Sometimes the broker actually open a position against the trader, and that's called the dealing desk operation. Dealing desk operation is illegal in Australia and many parts of the world, but people still, the broker still operate those one under different names and different ways. The major currencies which we trade, there are USD, Euro, British Pound, Japanese Yen, Swiss Franc, Australian Dollar, Canadian Dollar, and the New Zealand Dollar. So these 8 currencies cover 90% of the volume of $5.3 trillion a day. The trading normally happens between the pair of each of those. So for example, the Australian dollar and the US dollar, it's a one pair. Euro US is second pair. Euro AUD the third pair, and that's how they actually trade. So with this 8 pair, you normally get 28. Sorry, with this 8 currencies, you normally get 28 pairs to trade with them. So you will have 28 symbols available each day to trade on that one, and you have to find from the one which is profitable for that particular day. These are some of the major pairs: Euro AUD, Euro USD, Australian Swiss Franc, Euro Pound, Pound USD, Euro JPY, USD Swiss Franc, AUD USD, Euro AUD, and those ones. Normally, I do not trade any pair which have a New Zealand inside of them. The reason why, because New Zealand dollar sometimes goes very, very violent, and spread between bid and ask can actually go significantly high, like for example, 10 pip or 15 pip. So I normally try to avoid any currency which pair with the New Zealand. My favorites are AUD USD, Euro USD, Pound USD, AUD JPY, USD JPY, Euro AUD, and Euro Pound. You can also trade Canadian dollar as well and the Swiss franc, but I normally avoid New Zealand dollar at all. Now we come to the exchange rate. That's how the exchange rate works in this scenario. For example, somebody says that's the rate of the euro is 1.22156. What does it mean? That's 1 euro will buy that much against the USD. So this actually always trade in a pair. So the first currency, which is on your left-hand side, this is called the base currency. The second currency is actually called the quote currency. The base currency always have the unit of 1 and the quote currency, whatever the price actually quoted. So when you say Euro USD is 1.22156, it means that 1 euro will buy 1.22156 US dollar. What is PIP? So PIP is actually price in point. And price in point means like this point, you got it up here, the decimal point, and anything after decimal point, this is actually called PIP. The last one is actually a fraction 1/10. So we don't consider that one. We only after the decimal point, we consider 4 for our major counts of 1, 2, 3, 4. This is 1 pip, 10 pip, 100 pip, and 1000 pip. And this is then is a full unit. For example, if Euro USD move from 1.22156 to 1.22166, that is 1 pip move. We don't count this one. Most of the time now is the MetaTrader 4 and many broker actually quote in 5 digits after the decimal point. We consider only this one as well. This is very, very fraction. So that's, we just ignore that. JPY, PIP for the JPY is a little bit different because they only have 2 digits after the decimal point, and this third one is again is a fraction. So this one is 1 pip, 10 pip, 100 pip, 1000 pip. So because the currency is traded in more like a bit more fractions, so that's why they got after the decimal they got only 2. If the USD JPY move from 100.123 to 100.133, that is a 1 pip move. Pip calculation. Each currency has its own pip calculation. Pip calculation is actually the general formula for pip calculation is pip divided by the exchange rate. So let's say 1.5250 is an exchange rate for USD Swiss franc. What does it mean? That's $1 will buy 1.5250 Swiss franc. Now, we always know that the single pip is the 4th digit after the decimal point. So 1, 2, 3, 4. So that's 1 pip divided by 1.5250. And that's actually come up decimal point 0.0000655. So that's the value of 1 pip in this currency pair. So we just note down this one, and that information will actually come soon to you to understand why it's very important. So USD, Swiss franc, the value of 1 pip is equals to 0.0000655. So it's 1, 2, 3, 4, 5, right? We just write down this one at the moment, and we will talk more about in upcoming slide. The same way you can calculate the pip for USD Canadian dollar and USD JPY. The calculation of the pip is a little bit different when US dollar is the second or quote currency. For example, 1.2200 is 1 pip divided by that one, which become this one, and it's actually come up 8196. If you multiply 8196 by 1.222, that's become 1 single pip. So this become one point, right? So we will come to this again when we move a little bit further. Spread. Spread is the difference between bid and ask price. If the bid price is 1.1086 and your ask price is 1.1084, the spread is 2 pip. The bid price is the price which you actually bidding when you buying something. An ask price is actually what's the other part is asking, and you have to pay when you want to actually buy something. There is a way you can actually simplify this one a little bit, and it's very, very easy. You just simply need to do, just go into the Google and type the difference between bid and ask, and it's got a very, very nice link. It's that will actually show you. So you just do versus that one, and it will actually tell you that the ask price is always higher than the bid price, because this is the price where you will buy, and the bid price, this is where you will sell. So it's always a different. Leverage and margin. A lot is a contract size of the base currency. The currency always traded in a lot. One lot is equal to 100,000 base the currency. The mini lot is equals 10,000 and micro lot is equal to the 1,000. Very simple. Lot and contract size. So if, for example, if you want to buy one lot of Euro USD, then it's mean 100,000 Euro USD you're going to trade. Euro USD quote 1.10867. It means to buy one lot of Euro USD, you require $110,000 and $110,867. Just imagine that if the price move from on one point on this one, then your investment, you will actually make whatever the amount, you just multiply by that, and that's will become a crazy number. So we'll see on that. Let's put it that again. So the Euro USD one lot, that's it. So $110,867 for one Euro USD lot. The broker, and now you know that with that much amount of the money, if you need to trade one contract, then it will become almost impossible for this market to survive, because many small investors or like the traders like you and me, we don't have that much amount of the money just to trade one contract size position. So that's why the broker actually offer a margin account or the leverage account, and they will actually, their offer is actually based on, for example, if you 2 to 1, 10 to 1, 50 to 1, 100 to 1. In America, in United States of America, by law, the broker cannot offer more than 50 to 1 margin. In Australia, you can do anything you like. Europe, you can do anything you like. The most common leverage margin is 100 to 1 or 500 to 1. What does it mean that's 100 to 1? That's initial capital you invest is $1,000, but with the $1,000, you have a purchasing power of $100,000. When you make 1% profit, it means that you make $1,000 profit on this entire purchasing power or whatever you got here. So, and if you look at that way, so 1% profit and loss on this amount, but your initial investment is $1,000. So 1% profit in $100,000 is almost become 100% profit on your initial investment. So that point is very, very important. Without leverage for €1, you need that much. For mini lot, you need 11,000, and for micro lot, you need $1,100. With the leverage of 100 to 1, €1 USD lot size is the amount required $110,867. Broker will give you $10,975. Your fund is $1,108, and that's become market exposure of $110,867. What does it mean in the simple term that you can buy the €1 USD lot for only $1,108? Your broker will actually fund the other part, rest of the money which is required for that one. You have to be very, very careful, because it is a leverage account. It doesn't mean that's the broker risking his fund here. He is not risking any single fund. What will happen? You open one lot contract for Euro USD. The amount in your fund or in your account is locked, $1,108. Broker provided rest of the one. Now the price is actually moving up and down, up and down. And if the prices start moving down against your position, when it's reached your $1,108, broker will liquidate your account. Some brokers, they don't liquidate your account here. They will actually wait for your entire account to be wiped out, and then they will close your position, liquidate your position, and basically you lose everything. So you can see here that broker hasn't lose anything. He actually, when the risk actually or the losses reach your account level, he closed your account and he took all the money. So broker didn't risk anything, but you are risking on this one. This is the reason why the stop loss is very, very important. And you need to understand that what is your risk, how much you can afford, and whether if this particular risk is become 5% of your total investment portfolio or not. That's calculation we will learn during this 2 days training. So the margin call is when your account balance fall below the margin requirement, your broker will liquidate all your position to prevent your account falling into the negative. Money management and risk management is very, very important. Module 1 is again beyond that one, and we are now looking at buy and sell, long and short, and what's the difference between the two. For example, this is the current market price. You go long on Euro USD, it means you buy Euro here and you sell USD, you open your position, the prices start moving higher and higher and higher, and then it's reached up here, 1.22570. Now you decided to close your position. There are two ways to close your position. You can either simply click close and it will close your position, or you put a sell order for this one and it will close your position. Either way, you were long when you actually come into this trade from this position to this position. And because you bought the base currency, which is the euro, that's why you were long. You made a profit of 10 pips from here to here. So your net profit is a 10 pip. 1 pip is almost equal to the $10. How it's equal to the $10? If I can go back here, a bit here on this one. So you can see that's because your investment is only $1,000, and if you just multiply this one by 100,000, so that's become actually $6.55 1 pip value. So you make actually 10 pip profit. 1 pip is equal to $10 on rough estimate for Euro USD. Your total profit is from here to here is $100. How much you actually have risk here, because you have purchased one lot, it means you actually from your account is actually the amount was locked was $1,200. On $1,200, you make $100 profit, which is around 8% or 10% or something, 12%. So this is the long position, right? We don't call this one, we can call it's a buy, we can call is a long as well. The reason you don't want to call it buy, you will understand in the next section, or you will see. For example, at this prices, you want to actually buy USD. It means now you have to sell euro and you have to buy USD. So your position will open here. The prices start moving down towards because the US dollar is getting stronger. It's moved from 6.0 up to 5.0. Again, 10 pip profit, 1 pip equal $10. You make $100. If you say at this stage that's I sell euro USD, it can have two meaning. Meaning number one, that's you already own euro, you already have euro USD in your account, and you want to sell that one. Or you can call it short. I'm shorting. When you say shorting, everybody understands that you don't have this position open at all, but you are actually going into this, you're going to buy US dollar here. So that's why we don't like to sell the term sell and buy, but we want to use long and short because they are more clear. Sell means that I can be selling something which I already own. But the short mean that's is only one meaning. That's yes, I'm selling something which I don't own right now. So order types, there are 6 order types: market order, market buy, market sell, buy limit, stop sell, stop buy, and the sell limit. We do not trade anything on the market buy, market sell unless it is necessary. Most of our order are stop buy or stop sell, buy limit or buy sell. Buy order, they mostly actually work in that way that this is the current prices and you think these prices will move up, but you want confirmation. So at certain point higher, you actually put your order that's okay, if prices is crossed this one, then my order will execute. This is your buy stop order. The buy limit order is that the prices will go down and then come back, and at the lower place you want to buy something. The same thing will happen for your sell order. It's just the reverse. So let's say, for example, the price is going down and you said, okay, it will hit my, that line here that I want to confirm that yes, prices will continue to go down. Then I will buy here. Sorry, I will sell here. The sell limit, that's you wanted to sell something, but the price is already moved up and it's too much. So you want to wait for the prices to reverse and then you actually want to sell it. So it's directly opposite to the other one. I will stop this recording here because I'm going to have another session in about 3 minutes time, but maybe I will record another session to continue from this one, from this point onwards. So right now I will stop this video recording now, and we will actually have another video recording of maybe another half an hour or so. Thanks very much for the watching, and we'll see you soon. Assalamu alaikum, Salman bhai.